Okay, so in this video, I'm going to talk a little bit about free cash flow valuation. So what do you do if the company doesn't pay dividends? Well, because if they don't pay dividends, then all the dividend models that I've talked about in some of the prior videos aren't going to work because they don't have any dividends. What do? Well, one of the models that you could use is a free cash flow valuation model. So it's based on the free cash flow of the firm. So one way that you could implement that would be the standard free cash flow valuation model. You can do free cash flow to equity, where you adjust the free cash flow to find the value that is attributable to the equity, and then you start working with that. Or you can do what I'm going to describe here, which is you use the overall free cash flow and you value the firm with that, and then you make adjustments to figure out the value for the equity. So basically, the idea behind the free cash flow is this is the cash flow that is not free in the sense that like it just came to us. It's free in the sense that it's available for the firm to use to reinvest in the business and things like that. So it's available for more investments and additional growth in the business, available to be paid out to shareholders and lenders, et cetera. So basically, what you're going to do is you find the free cash flow for the firm, and then we for that we're projecting for a number of years, and then you discount it at 1 plus the weighted average cost of capital. So this free cash flow 1 is the expected free cash flow at the end of the first year. Free cash flow 2 is the year after that, 3 the year after that, and so on. So we find all the projected free cash flows, and then I divide it by 1 plus the weighted average cost of capital raised to the appropriate power. So basically what we're finding here is free cash flow is a future value divided by 1 plus a rate of return to the 1. So what we're finding is present value of free cash flow 1, present value of free cash flow 2, present value of free cash flow 3, so on and so forth. And we just go on to the infinite future. So basically, I find the present value of all these infinite free cash flows, add them all up, and that should give me the value of the company. So notice that I have a subscript C here to denote the value of the company. Now, the weighted average cost of capital bears a little bit of discussion. Basically, what that is the overall rate of return that you need to earn to keep all of your lenders and shareholders, et cetera, happy. So basically, it's the overall weighted average return the firm needs to earn to keep all of its investors, not just these shareholders, but all of its lenders as well, happy with the return that they're getting given the risks that they're taking. So basically, I use that weighted average cost of capital to find the present value of all these free cash flow terms. I add them all up, and then I get the value of the firm. Now, if you're looking at this and you're thinking, so I have all these free cash flows going on in the infinite future, this should start to sound a little bit like some of the dividend valuation idea. And it's the same concept. So instead of finding the present values of an infinite stream of dividends, we're finding the present value of an infinite stream of free cash flows. And that does bring up another little note. Well, what if the free cash flow is expected to grow at a nice stable rate? Well, if the free cash flow is expected to grow at a nice stable rate, so in other words, a constant rate of growth, then you could actually do a calculation kind of like we did with the constant growth dividend stocks. So instead of doing D1 over RS minus G, where G was the constant rate of growth in the dividends, what you could do would be free cash flow 1 over the weighted average cost of capital minus the expected growth rate in the free cash flow. And that would give you the value as of today of this infinite series of growing free cash flow figures if they're growing at the same rate. So I could use that same formula, basically, just make the adjustments. I'm using free cash flows instead of dividends. I'm using the weighted average cost of capital instead of the required rate of return for shareholders. And basically, I can then find the present value of an infinite series of constant growth free cash flow. Now, it's important to note that with what I have here at the moment is we're calculating the present values of all these free cash flows. That technically gives you the value of the whole company. So if I find the value of the whole company, we want to find the value of the common stock. But I need to take the value of the company, subtract off the value of the debt, then subtract off the value of any preferred stock. Whatever is left is the value for the common shareholders. So let's suppose I calculate the value of the company and it's $100 million. So if it's $100 million, but debt is 40, so I take 100 minus the 40. Let's say preferred is 10. So 100 minus 40 minus 10, what I'm left with, the value of the stock is actually $50 million in my example. And once I found the value of the stock at $50 million, if I wanted to find the value per share, what I could do is then take that $50 million, divide it by the number of shares that are outstanding. That would tell me the value per share. So we do need to have the value of the debt and the value of the preferred stock. And importantly, technically, this is the market value of the debt and the market value of the preferred stock. It might be a little bit tricky to get the market value of all the debt because of the fact that a company can have dozens of different types of notes and bonds outstanding. So sometimes you can make an approximation of the market value of the debt using the book values of the debt on the balance sheet. So looking at, say, long-term notes payable, long-term bonds payable, things like that. It is a bit of an approximation, though, and that's going to be subject to more error if the market value of the debt is deviating more from whatever that value is on the books. But if you don't have a good market value figure, that's where you can possibly get there. And that kind of assumes that the debt is relatively on the balance sheet is sort of on average reflecting approximately market value. So we don't have big huge discounts or premiums or things like that going on. No huge shifts in the company's likely probability of bankruptcy, et cetera. Otherwise, if you think that some of those factors are in play, then really you would kind of want to go back to actually adding up the market value of the debt and chasing down each of the individual bonds and trying to figure out what the market values are and therefore arrive at the full market value of the debt that way. But for our purposes, for the most part, generally, we're not going to have a situation at this point. I'm not going to talk about at this point, going into all that detail. That's probably more than I want to get into in this particular video. But hopefully that helps. Hopefully this video makes a little bit of sense. And thank you so much for watching and have a great day.